Happening in terms of the market action, but we are in the thick of the earnings season, so there's lots to talk about on that front. Let's get a conversation going. We have South Indian Bank, which is moving in trade after reporting its Q2 numbers. Now, while the operating profit came in weak, the net interest margin, along with the asset quality, has improved quite well. In fact, if you take a look at it, the provisions are also quite a lot lower this time around, and that is what has aided the earnings. So to discuss the quarter gone by and the outlook going forward, we are joined by the management. Mr. PR Seshadri joins us. He's MD and CEO at South Indian Bank. Mr. Seshadri, thanks a lot for joining us. This is Pavitra. So I'll begin by with one of the key positives, which is the fact that your asset quality has improved quite a lot this quarter. Can you tell us what is the outlook on this front? How much more of an improvement can we expect on the asset quality, say by the end of this year, by the end of FY24?
Morning, Pavitra. Thank you very much for having me on the show. As you mentioned, the quarterly results which we announced yesterday, were in line with what we were expecting. Our assets went up by about 10%, liabilities went up by about 10%, revenue went up 21%, and pre-provisioning operating profit went up by 8%. The asset quality numbers, as you mentioned, are much better than where they were in the past. Net slippages were down to about 42 basis points for the quarter. This is not an annualized number, but a quarterly number. We expect the numbers to continue in this range as we move forward. The book has been substantially repositioned from where it was in the past, and consequently, we think that the performance on the asset side should remain where it is at this point in time and improve as we go forward.
But some more numbers, sir, on the asset quality. Will slippages stay around 300, 350? What is the visibility in Q3 and Q4? Is there any risk from the unsecured retail credit book? And would you like to give us a number on gross NPAs? You've brought it below 5%, but where from here?
Slippages for the quarter, ex a one-time adjustment, were about 294 crores. We suspect that the slippages would be in the same range, if not a tad lower than where we are at this point in time. And that's the expectation over the next 2 quarters. The gross NPA will continue to decline as provisioning catches up. And also there are write-offs that are taken to actually bring these things down. And recoveries have been very strong. Last quarter, our recoveries were in the region of approximately 475 crores or thereabouts. And since recoveries are greater than slippages, the gross NPA numbers continue to trend down. So we've trended down approximately 71 basis points over the last 12 months. We expect that trend line to continue.
So 4.5% gross NPAs by Q4 FY24, is it doable?
Yes, if the current trend continues, yes.
Okay, that is on the asset quality. Mr. Seshadri, one part that was not perhaps so encouraging from the numbers is the fact that the loans and deposit has not grown very well. Can you take us through what happened? Is there just overall weaker demand that you're seeing? Is it that you're finding it tough to grow in this market because of competition? Can you tell us what happened on that front and what can we expect from here on as well?
On the deposit front, our deposit franchise is a particularly strong one. Deposits grew 10%. CASA actually year on year has grown 2%. I know the number looks small, but in the context of where CASA growth is in the industry, this is a reasonably good outcome. We are very confident that on the deposit side, we will continue to grow the way that we are, we would like to. On the asset side...
So how would you like to, sir? How would you like to? You said we will grow the way we like to. How would you like to grow on the deposits?
So the deposit side growth is moderated by the asset side, frankly. I mean, if we have outlook of greater asset placements, then we are confident that we can get greater deposits. The way we are positioned on our interest rates that we pay out on deposits, we are at the lower end of the spectrum compared to our peers. And consequently, we are actually moderating deposit growth for ourselves at this point. As you rightly mentioned, our asset growth has not been as strong as we would like. And that is essentially because we are focusing more on quality as opposed to quantity. And in the environment that we are operating in today, we took a conscious call to keep our growth moderated to a level that we think is acceptable to ensure balance sheet health as well as reasonable returns to our shareholders.
Moving on then to the net interest margins. Net interest margins for the current quarter have come in at 3.31%. Was there an impact of the ICRR on your margins? If yes, how much was it? How were you able to offset it? And I remember our last conversation with Mr. Ramakrishnan. He had guided for net interest margins to increase to 3.5% by March of 2024. Do you think you will be able to get to that level of 3.5% NIMs as exit margins?
It'd be a little difficult for me to forecast where the NIMs will be as we exit the year. The structure of the balance sheet is such that we have approximately 40% of our assets to corporates, and there the NIMs are not as high as in other products. As a consequence, our net interest margin for the whole book is a little lower than our peers. And what we are trying to do is to build the rest of the book, as Mr. Murli, who was my predecessor, was doing in the past. So the aim is to grow MSME and retail aggressively and grow the NIM. Unfortunately, the entire banking industry is facing a challenge in that liabilities are repricing at this point in time a little faster than assets. And therefore, I think not just us, but the industry itself will be facing a reasonable amount of challenge when it comes to the NIM side. So I'm a little hesitant to say that our exit rate would be 3.5, but that's the aim.
So directionally, margins stay at these levels, sir, or do you think it can improve but may not go to 3.5%? Directionally, can you give some thought to this?
Directionally, our aim is to improve the margins from where we are and aim towards 3.5% in the fullness of time.
All right, we're going to leave it at that, Mr. Seshadri. Thanks a lot for joining us. We do hope to get a few more numbers from you the next time we do talk to you. But thanks a lot for taking us through your outlook on where things could really be headed for South Indian Bank. The stock is holding up quite well today. It's up 1.5%. Otherwise, also it's done well. If you take a look at, say, 6-month chart, it's up around 70%. So that is the chart of South Indian Bank. We do need to get into a short break now. But on the other side, we're going to speak with Uday Reddy from Tanla Platforms. That stock is surging in trade after their Q2 numbers. So stay tuned and we'll get you that chat.